Now, first up, we're going to discuss private debt and Metrics. So most people in the room know Metrics as Australia's leading and largest non-bank lender to corporate Australia. They're lending on a very similar size and scale as a Macquarie Bank. Metrics' flagship fund, their Metrics Direct Income Fund, really sits at a core allocation within fixed income within your portfolios. Why is that? Well, it provides a capital stable investment that provides consistent, reliable and regular income. But what makes Metrics different versus the other non-bank private debt providers out there? Well, firstly, Metrics originate their loans. They structure terms and conditions, and importantly, they're not just buying a book of syndicated loans off others. But being skilled in origination and assessing corporates also enables Metrics to invest across the capital structure and have a range of funds with different risk and return profiles. So please welcome Andrew Tremain. He's the other Andrew at Metrics. He's a partner of Metrics, and to take you through how they're assessing and investing in private markets. So please welcome Andrew.
Thanks, Mark. Yeah, we try to keep it simple at Metrics, so it was probably part of the job description. Yeah, you had to be named Andrew to get employed there when I got there, so I think that's how it worked for me. For those of you who don't know me, I'm one of the 4 partners at Metrics. Metrics was a business we formed. We raised our first piece of investor capital back in June of 2013. At that stage, we'd actually been putting this business together since 2009 out of the back of the GFC. When you saw all the international banks retreating from the Australian market back to their own domestic markets, the domestic banks here struggling to fund themselves. So we came up with a thesis, an idea of actually starting a private credit business. We warehoused some assets on NAB's balance sheet, and we set up a fund, and we were successful in raising $75 million. So we had our first investor, and that's where the business started in June of 2013. Since then, we've gone on to, so the business started with 3 people. It's now up to about 165. We've got offices in Sydney, Melbourne, Auckland, and we're just taking some space in Brisbane, and we've got a couple of people in Perth. The business now grown to just over, I think we've just pushed through $21 billion, and the majority of that money has been raised in Australia, from Australian retail and importantly institutional investors in Australia. Over the 11 years, the funds, we built the funds out, and segregated, risk and return, so the investors have choice to actually, what they're actually investing in, how much risk they want to take, versus the return. This is a very large, scalable market. I remember going around to see institutional investors when we started raising money and saying, look, this institutional loan market, this is how Australian corporates fund themselves. So we're not talking about service station or the corner shop type businesses. Generally, these are things worth at least 100 million, if not $200 million. So reasonably sophisticated borrowers, and we're going. So this market, that banks are actually lending to, there's $1 trillion of assets out there in the market, dominated by the 4 domestics. I remember talking to investors, and they're saying, "You're telling me that there's $1 trillion of these things sitting out there, outside the bond market?" We're like, "Yeah." They're like, "I don't believe you. I've never heard of it." We're like, "Well, it does exist, and that is what the bank's business is, which is lending to these companies and generating an interest margin." So what we've tried to do here and create for investors is, we're not trying to generate a synthetic return. We're not trying to generate a return out of borrowing money and taking some investor capital and then lending it to companies or projects. We're trying to give a straight pass-through of the risk, which is we lend to something, generate the interest margin, get the money back, reinvest it, lend it to somebody else. And we try and do that in a diversified and scalable way. So this is a big scalable market and big scalable opportunity. So $20 billion out of $1 trillion worth of assets, dominated by the 4 domestics, there's an enormous opportunity here. So it's taken us 11 years to get to this stage, and so we see plenty of potential for further growth here. And so the key thing that you need to think about from a private credit perspective is, obviously, your manager selection is key. You want somebody who can operate size and scale. We built this business out to over 300 odd corporate loans across $20 odd billion. The domestic banks here will continue to cede market share, and so the opportunity is that eventually that $1 trillion worth of assets held on bank balance sheet will need to find another home, and it's not going to be the bond market. And if you look at what's happened in the rest of the world, it's effectively migrated into a private market. The challenging thing for investors is this is not something you can buy and sell on a screen. It's not something you can, I can't buy this portfolio of loans. You actually have to go out there, meet borrowers, find the opportunities, and then actually negotiate them, tailor them, structure them, and get the money out the door, manage it, and then get it back. It's a people-intensive business. That's why there's 165 people inside the business. And so if you see a manager with a staff of 2 telling you they've got a diversified portfolio of loans and this is fine, it's probably not. The way that we think about the market, we segregate it like banks do into 4 key sectors. You've got your corporate, so we lend to people like Woolworths, Ramsay, Ampol, Origin. We lend to private companies, large sophisticated private companies. We do a lot of leveraged finance, which is private equity firms, whether it's KKR, TPG, Blackstone, all the way through to Quadrant, Anchorage, Next in Australia. Very sophisticated investors where we're lending money alongside their equity, to effectively drive returns for our investors. Big part of our book is commercial real estate. Real estate is something that we've been doing for a long time. We like real estate. It's very, very difficult to actually get real access to debt in real estate outside public REITs, or other listed structures. The beauty of ours is what we're concentrated in is resi development, capital cities, high density, appealing normal stock for large sophisticated residential developers. A lot of developers you'd never have even heard of because they're private, but they're people who are in their own right worth some billions of dollars and stand behind their projects. So we do a lot of that. We do a lot of industrial. What we don't do is office, retail, student accommodation. And we're not doing rural agriculture or semi-suburban. So we're very much concentrated into where there's actual demand for the actual end product. Because with real estate, and it's a really careful thing to actually understand, which is when you lend for real estate, you don't get repaid from the value of the asset, you get repaid from cash. So you need to make sure that the value of the asset can actually turn into cash. You can get your money back. We're not long-term holders of real estate, we're financiers of real estate. We want to lend the money, we want to get it built, we want to generate the return, we want to get the money back. And then we want to do it again. And you want to keep it tight and you want to keep it short. The other big sector of the market is project finance. So we do a lot of infrastructure. We've done pretty much every toll road in the country. Victorian Cancer Centre, a bunch of desalination plants, etc. So for us, the way that we think about how we run this business, it's direct origination is important. We've touched on this already. We're not out there waiting for somebody to come and bring us a deal. We run a relationship model, so we want to deal with borrowers who want to deal with us, and we rely on repeat business out of the same client base. So a lot of our property development, a lot of our private equity business and our corporate business is off the back of transactions that we've done before and people we've got a history with. That's really important because not everybody behaves how they should behave, and you want to make sure that if there is a problem, you're going to be dealing with reputable people. If you have to rely on your legal rights as a lender to enforce or get your money back or enforce it, that's fine. Every now and then that happens. But what you've got to be really careful about is that you're dealing with proper individuals with a reputation and a belief and an understanding of where they sit in the capital structure and actually value what we bring, which is our investors' capital to help them drive their businesses or their projects. And then you need to be able to manage that, and you need to be able to do it in size and scale. So if you go to lend to Woolworths, for instance, it's like going for a job interview. There's a minimum ticket, so you need $50 million. You need to have a rating of your own fund if you want to do that. So we're the only A-rated debt fund in the world. It took us years to get that through S&P. Because most debt funds don't do what we do, which is we're generating the return, but we're not relying on leverage to give you a synthetic return out the back of that. We're actually trying to do a straight pass-through of the risk, whereas most debt funds rely on leverage, and by relying on leverage, you increase the inherent risk in the structure, which exposes investors to additional risk that you just don't really want, and probably a lot of people don't understand that. So, when you go to Woolworths, you've got to have a minimum credit rating of BBB. You've got to be able to deal in size and scale. And from an investor's perspective, you want diversification. So you don't want to be invested into 5 core assets, and that's where all of your money is. Because if there is a problem with one particular asset, even if it's for 2 cents, you don't want that to be concentrated in your portfolio. So for an investor, for us, at the MDIF level, you're exposed across 300 odd names, so that you've got true diversification. When we say across 300 names in terms of diversification, I think the largest exposure is just over 2%. You don't want to be exposed to 300 borrowers, but 50% of it's in 3 names. We think about risk and where debt versus equity sits in terms of private or public markets, but particularly private markets. What we're concentrating on here is that piece of senior debt. It's the lowest part of the risk capital structure. What you can't do is lend some money here, lose 10 cents and make 10 cents on the next. This is not an equity position. These are true debt positions. You have an obligation of face value of what you're owed, and you've got to be able to make sure that you can get that back. You can't lose $10 here and make $10 over there. It doesn't work like that. If you lose $10, you lose $10. So what we're focused on is making sure, from a private credit perspective, you're lending the money, you're generating the return, and you're getting it back. This is the way we set the structure of the funds up. The reason we've tried here, basically the fund structure is on the basis of segregating risk and return. So the assets are held in the underlying blue boxes down the bottom, the dark navy boxes. Institutional investors invest direct into those funds. The liquidity parameters in there are not the same as up the top at Metrics Direct Income Fund or MXT or MOT. Obviously, the listed products just trade on the exchange at a listed price, up or down from the NAV, depending on what market conditions are doing. At NBIF, monthly liquidity, but you trade at the NAV. Those all feed down into the underlying structures, which is how you get your diversification. So you're not getting a doubling of, a layering of fees, and you're not getting the disadvantage of being disadvantaged outside where the asset pools are. So you're actually directing down through the feeder funds directly into where the assets are held, and that's what your exposure is. Importantly, this, we talk about this often, but this was out of the back of the GFC. Prior to the GFC, banks didn't actually have to record their loss rates back to the regulator. The outcome of the GFC in Australia out of institutional corporate loans, the actual losses out of that, we'd say GFC 2006, 7, 8, the actual losses came out in 2009. You see that they peaked at 0.67%. So, very low loss rates. Remembering that corporates through the GFC were levered far more than they are now. So you'd say now on a relative basis, corporates are certainly over-equitised to where they were back in 2009. Nonetheless, the loss rate's 0.67%. And you can see, right down the bottom, in the last 12 months, loss rates of 0.08% coming out of the bank balance sheet, which is where you're concentrated here in our funds. This just talks about how we deal with borrowers around the relationship-driven model, and also the structural protections you get here in Australia. Pretty much, I've worked here, the US, the UK, Europe, and across Asia, including China. In terms of your rights as a lender, your legal rights, and the obligations that sit with companies and directors, this is, in my opinion, the best country in the world to actually lend money. It's the country where you can actually do what you want as a lender and take controls if you need to, which drives a certain level of behaviour, which is why you see very low loss rates. Private credit, as opposed to a bond market, you can see there what we're really talking about here. These are all floating rate instruments. So it's effectively over BBSY, which is a proxy for the RBA cash rate. So 99% of the lending that we're doing is floating rate. So as rates go up, your interest coupon goes up. As rates come down, your interest coupon will come off. What that does, as opposed to a bond, as rates go up and you feel it in the capital value, provided your credit is okay and you're not getting credit impairments or credit losses, you'll actually be in a position where you don't feel it through the NAV, basically. So you don't lose money because of rate volatility. You actually just follow it effectively as a natural hedge to inflation. And you'll see that as inflation's increased over the last few years. And if you look at the return series across our funds, you'll see that the rates and the returns have just increased in line with that. Just a very quick slide on something we listed last month, which we're very happy about. We did a new LIT. It's a real estate equity strategy, effectively paired with a real estate debt strategy, listed on the ASX. It's really development equity that half that money goes into. We had a target of $100 million. Raising money in a public market in Australia in the current environment is incredibly challenging. A minimum of 100, target of 300, and we raised 303. So we're very happy to get that done and that launched, and we think that's going to be a great outcome for investors in the coming future over the next few years. Of that, we've done a number of seed assets in that fund, large real estate land subdivisions in southwest Sydney. I think that particular site's 1,500 sites. They sold over 100 of those in the first 2 stages over one weekend at rates that we thought we'd be getting in stage 13 in 3 years' time. So it just shows the underlying demand. So we're funding that from a debt perspective after the equity's gone in, but they've already sold about 10% of that stock that's just coming into development. So most importantly for us, we would say manager selection is key. Make sure you pick somebody with experience, track record, size, scale. You need diversification, and you need a model that actually focuses on direct origination, as opposed to, you don't want to be relying on a broker-driven model, or banks to come and present something to you that's finalised, structured and finished. You want to make sure that you're actually investing in a manager that's actually got control of their own destiny, the structure, and the terms and the conditions and the pricing that goes with it, direct with the borrower. It's time intensive, but it's the best way of minimising and reducing your credit risk. And then you need an experienced portfolio team to actually manage those assets over a period of time, make sure that you're actually getting the money back. Thank you.